excited about this. At Vetify, I have the crazy title of financial futurist. And what that means is I try to figure out what's interesting and new and different that's going to change how we think about our jobs day to day, whether that's working with clients or running money or anything in between. Two of the things I'm focused on this year and next year probably are why is the fixed income market so incredibly archaic that like fixed income has to change? And that's changing in lots of ways. We're going to talk about some of those, from trading to how we actually think about the act of issuing bonds as a corporation or as a government. The other thing I'm focused on is what we can learn from the DeFi sandbox, what we can learn from the experiences in the crypto ecosystem, and how that's going to change how we do our jobs every day. And Brandon's probably the best person I could talk to about this because he's doing both at the same time. So Brandon, why don't you get started by talking to us a little bit about what Meow does, and then I've got a bunch of slightly annoying questions.
Yeah, awesome. So Meow puts side by side the ability to invest in DeFi protocols, institutional lending desks in the crypto space, and things like individual US treasuries. So 1 month T-bills, 3 months, 6 months, and 1 year, all through one platform. So you basically have a home for every dollar you want, whether it's unsecured lending in the crypto space, whether it's over-collateralized DeFi protocol, or a US Treasury bond or traditional finance instrument. So we're the only place combining those at Meow right now, which I think is pretty exciting to have kind of both worlds in one place.
And to put it in context for advisors in the audience, sort of how should they think about where you fit? I mean, you're not like bolted right into their platform. You're effectively a service that you can use to sort of simplify and streamline that cash process, right?
Yeah, exactly. Like right now, US Treasuries, as Mike was saying, it's archaic. You have to call people on the phone. You have to onboard for months and months. For us, it's a one-day process. You have a direct relationship with the broker-dealer, all programmatic to the platform. And you don't have to onboard to 20 different institutional lending desks in the crypto space either. With us, we're an aggregator for all of them, so you can select them by name. It's not like a BlockFi where you deposit and it just says interest-bearing account, and you've got no idea what's going on under the hood. So this is like self-selecting, one onboarding, super clean for any of those needs, basically.
So a lot of I think a lot of folks who were watching crypto over the last year, particularly around some of these issues. I mean, we're talking about yield farming. I know not everybody likes that phrase, but the idea of taking something, loaning it out, collecting that, it's effectively a kind of stock loan, except for crypto, is how most of those things work. Obviously, crypto's come down a little bit since most of us were in an audience together. What have we learned in that, and how has that changed what you're doing in this business? Because obviously there were some pretty high-profile blow-ups in the yield farming space.
Yeah, so a lot of those were IQ tests. The people who failed those IQ tests, they're egregious offenders. So something that the industry has learned is that you can't take a firm attesting to their own health of their own balance sheet at face value. You need third-party attestations to their equity positions. If you're getting collateral from that person or that entity, you need to actually have that collateral. In some cases, we heard stories of people pledging the same collateral to 3 or 4 places. They would attest that their balance sheet is healthy, and that would be enough for a lending desk. This industry is maturing in front of your eyes. And yeah, if you pick the right partners, the reputable ones from day one, which we did, we didn't have any losses on our platform, obviously, but there's some maturation happening right now, and it's going to be super healthy for the space.
I mean, you mentioned that it's sort of failing an IQ test if you got caught up in these things, but I think it's reasonable that folks who are not in the business of like reading smart contracts for a living, that we're in a bit of a loss for how you trust something. So what is it that you're doing that allows us to trust that you're doing that IQ test for us and passing?
Well, the IQ test is just understanding that the risk reward at least makes sense on paper. It's not saying something's no risk, right? Some things like UST, if you guys remember UST, that didn't make sense at all. That was something that was collateralized, something that was supposed to hold a peg to $1 that you can earn yield on, that was collateralized by a volatile crypto asset. It wasn't collateralized one-to-one with a real fiat dollar like USDC or the Gemini dollar. So that's when newcomers to the crypto space say, oh, there's all these attractive yields paying 20%. Let me just share them with the world. That's the wrong way to go about it. You need people who are working on the ground floor of this industry for 5-6 years to at least curate where the risk reward might make sense on paper.
Is it as simple as that a lot of these things that blew up weren't fully collateralized, or were there other things going on?
Some things just never made sense. What did work in the DeFi space, like a clock, is the over-collateralized borrowing and lending protocols. So the ones in which you can get
Give us a walkthrough on that. What is an over-collateralized borrowing and lending platform? Like, make a really specific example. Pretend I'm an idiot because everybody else does.
So something called compound, for example. So if I want to borrow dollars, right, effectively dollars. If I want to borrow USDC, I would first have to pledge Ether or Bitcoin, a different asset, but I'd have to pledge more than I actually borrow. So I might put up 150% of what I want to borrow in Bitcoin to the protocol, right? And if I get margin called and I don't meet it, that protocol will liquidate me immediately and recover the principal. That ran like a clock. There's no humans involved there. Even during the crash, there's no cronyism, no bankruptcy procedures. That kind of stuff works like a clock in the DeFi space. Unsecured lending, which is the trillion-dollar industry, right? That is in its infancy. That does not really work right now in crypto. So that's a problem. There's no concept of credit scores. There's no concept of identity. The only things that work right now are when you actually hold something that's more valuable than what you've given someone. And that's not the whole lending market, but it's a start, and that's what crypto is very good at today.
So let's walk through an example. Let's say I'm an advisor and I've decided, hey, I've got this $1 million client. I want to work with you, or I have $1 million cash pool that I want to put with you. And I can look at the book and I can choose a whole bunch of stuff that looks like pretty boring treasury stuff, and then all this wild stuff that's got crypto names on it that I may or may not be familiar with. How should an advisor or an investor think about navigating the choices between the two of them? I think most people understand basically what a U.S. Treasury is. All that other stuff can seem pretty arcane.
Certainly, yeah. So if you're going to if you want to lend to an institutional lending desk, some of them are actually public, and you can actually see their equity positions. So you don't need to rely on them attesting to their own equity position. It's public information. So if their loan book is $1 billion, but their equity position is $15 billion, and they're offering to pay potentially 5% open term, you can do the math on that. Right now, 1-year T-bills are quite attractive, but there's a place for this. Just curating the right things is what's important. There's a place for kind of both in the portfolio. I can tell you on our platform, the traditional offerings are way more attractive right now to most of our customers, as you can imagine.
Just because the yields have come up, and that's now
exactly.
now a viable place to put cash for the first time in 20 years.
Yeah, it's super attractive comparatively right now to our customers.
You've got a substantial customer base already. Do you have folks who are doing both, that are putting a slug of stuff into 5-year treasuries and then a bunch of stuff into a DeFi lending pool?
Certainly, yeah. For some people, they strictly prefer, they think that they like the risk reward of something paying 6% potentially. That's collateralized in the crypto space. We definitely have people doing both. Right now, most of our net new customers are just for our T-bill offerings, 1 month, 3 months, 6 months. That's almost exclusively what we're seeing the past 2-3 months. Yeah.
So the way an advisor would traditionally handle this problem is probably just by buying either a money market fund or some other short-term instrument, a short-term ETF, short-term bond ETF. This is a very different way of doing things. What's the mental process you have to get through to think about doing this versus just going to my Schwab platform and buying a bond fund?
Yeah, this provides granularity in our dashboard. You can just click 1 month T-bill, 3 months, 6 month, 12 month, and you're interacting directly with the broker-dealer behind the scenes, and the treasuries are custodied at BNY Mellon. Whereas it may be a little bit more opaque if you're using one of those platforms like you mentioned. There's transaction fees that you pay. There's rollover. There's more price risk. You don't have the granularity. So this is just for simplicity, really. It's just when I ask people what's the easiest way to buy U.S. Treasuries, mostly competing with treasurydirect.gov, which is just archaic, and calling people on the phone, which is also archaic.
And how do you guys get paid?
We're able to take a transaction fee, 10 bips here. Not transaction fee, AUM fee here. That's really marginal. It's not going to move the needle too much. Right now, it's just customer acquisition for us.
Got it. Okay. So let's move on. We've used about 9 minutes here going through the baseline. Let's talk a little bit about what's going on in the crypto space, because the shakeout that we've seen, 3AC, et cetera, I think it's spooked a lot of institutions out of this market, and institutions were a big part of this lending market. What's your interaction with the institutional market like in this sort of post-crypto winter world we're in now?
Yeah, so right now no one really trusts each other, which is a good thing. A lot of the lending you see is over-collateralized strictly, or with public companies.
So it's a good thing because that means people will collateralize.
Yeah,
right.
And we won't have another 3AC kind of blow up where people are just making egregious decisions, lending them billions unsecured with self-attestations of their balance sheet. So right now we're seeing almost entirely over-collateralized lending. The unsecured lending market will come back, I believe. It's going to take a while. We're going to need third-party data sources. We're going to need attestations. But right now there's a lack of trust between these counterparties right now.
So in this market, like, so what is sort of a nominal yield you're getting out of the crypto side of the lending protocol right now?
Yeah. So it depends. If it's like highly over collateralized, it can honestly be like 4.5% potential yields, something like that, which there's not much delta there with a T-bill. So as you can imagine, the TradFi offerings are more attractive. If you go unsecured, depending on who you talk to, that could be 10, 11% unsecured.
But now you're in that world of just loaning money to your Uncle Bob and he may never pay you back,
Exactly
right?
right.
So
Exactly,
that's a different. But
Yeah.
in the securitized space, in the collateralized space,
Yeah.
if you're talking sort of 4 or 5% ish, are institutions in there playing? Is that interesting enough for them to do that?
Some of them think the risk reward is there. If it's highly over collateralized with a Bitcoin or an Ether, then if there's an auto liquidation clause at say 120% collateral, then in their heads they think of that as the worst case being a partial loss, right? That's in their heads. So having that as part of their portfolio seems to make sense for some people. Now, if you go partially over collateralized, it's not just over collateralized or unsecured. There's some that are like average collateralization of 90%, 80%. Those can pay potential yields of 7%, 7.5%. There's obviously greater risk there of a partial loss.
So what's the reason behind having a 90% collateralized protocol?
Yeah, some borrowers wants to only post a certain amount of collateral at the end of the day, and some are comfortable posting 200%. So it really comes down to who the people are. If it's under collateralized, you have to do a little bit of a credit assessment on them, which is difficult, right? That's what we're starting to get better at as an industry. So over collateralized is very clean and simple in a lot of ways, but the rates are not that much higher than a T-bill, for example.
And what is the? I mean, in all these cases, these are people borrowing things generally to sell them short, right? I mean, that's the reason these protocols exist. It's sort of acting like a security lending market.
Yeah, if you're borrowing Bitcoin or ETH or something like that, you're shorting. If you're borrowing dollars, you could be market making or something like that. Dollars being USDC in this case, which is pegged 1-to-1 with the dollar.
Right, and the reason you would need that is because you need to then put that in another protocol for something else that you're working on or transactions that you're trying to make or whatever. But you need those tokens.
There are indeed, if you're taking USDC, there are indeed I hesitate to say this. I mean, there are dislocations in price across exchanges. There are market-making strategies that can yield things. Market makers tend to make a lot of money in this space. So it's not like a lot of them are taking directional bets like 3AC was, but there are reasons to borrow USDC that makes sense, that you have some expected ROI there.
In the early stages of a lot of these protocols, a lot of the gauges about how much collateral you needed was based on the volatility, the short historical volatility we have of the underlying assets, ETH or Bitcoin or whatever. Does that still make sense? Because I feel like we've entered a world where we now sort of understand all of these things can be infinitely volatile in a short period of time. Yeah. Therefore, does it make any sense to say, oh, well, Bitcoin's less volatile or more volatile than ETH, so you can collateralize it more or less than that? Yeah. I mean, is there any truth in any of there?
I mean, the order books are deeper. They tend to be deeper for Bitcoin, for example. So the less liquid an asset, the more, like a lot more collateral you'd want. Now, ETH is having a pretty gigantic event coming up called the Merge in a few days. So we'll see. I mean, some people say that ETH is going to be the new global reserve, the store of value narrative as opposed to Bitcoin. So Bitcoin and ETH are considered kind of majors when it comes to collateral. And it remains to be seen which one has the deepest order books a year from now or 6 months from now.
And from your perspective, somebody who's playing in the space daily, does anything about the merge coming concern you? I mean, obviously you're moving ETH in and out here. That's part of the jam.
Some people post ETH as collateral for their loans, for example. If there is a black swan event, it's difficult to know exactly what that would be. That's something to think about. This is a big event, but all the tests on the test nets have all gone successfully. Everything seems to be quite smooth there. Everything seems to be going quite smooth on the merge side and the test net. So.
Okay. Yeah. So let's talk about what's next after the merge. Like, what's the next shoe to drop here in this space? Are you worried about regulation? Are you worried about new technologies? What are the sort of pain points you're looking at? And what are the things that you're excited about other than his car?
Well, regulations would just, it's a good car. Regulations are really coming after kind of the retail-facing stuff, which, I don't want to take too strong a stance here, but I think some cleanup is definitely needed for a lot of these predatory retail-facing apps where the founders were just smart enough to lose everyone's money or blatantly fraudulent. So not disclosing how the funds were being invested, passing it back to customers at interest rate, in a lot of cases blowing up if they were putting it into USD or lending to 3AC or something. So regulation can only help, in my opinion, thoughtful regulation. So that's quite bullish from an industry maturity perspective.
I mean, do you have any horse in the race about how you'd want to see things regulated? I mean, obviously there's a huge spectrum here. We've got Gensler changing his mind every 3 days about whether it's the CFTC's problem or his problem.
I don't believe anyone who says there's going to be a path to registration for these assets this year, or like these lending platforms this year. I don't believe that for a second. I think we're 2 years away, 3 years, best case. But there are ways to do this compliantly, like by facing accredited investors like we do only in the interim. But yeah, I'm not bullish on Gensler changing his mind and registering all these lending platforms this year. I don't think that's going to happen.
Yeah, I mean, I wouldn't think this year at all. But I guess one thing that I've been concerned about on the regulatory front is his stance has been so clearly that most of these tokens are securities, and that means we have to bolt them into the existing law set.
Right.
That would make a lot of what you're doing difficult, right? I mean, if all of a sudden the assets that were being pledged and used here, every one of them is a security, that changes the math. Are you concerned about that at all, or is there ways you think you can get around it?
It's a good question. So directionally, they've kind of alluded to Bitcoin and ETH likely being commodities, and that is still the major source of collateral. Those are considered the majors, and they're the deepest order books. So
at that point, it's just like posting gold, and that's fine.
Exactly right.
Okay.
Directionally, that's correct. Yeah.
Okay. So on the technical side, what are you interested in? What's got you excited about what's coming down the pike on the crypto side?
Yeah. What would really excite me is when we get unsecured lending right on chain, right? Because anytime you like eliminate middle people, you change the world. The internet ultimately just eliminated middle people, right? So unsecured lending is going to take a long time to do right on chain. You need a concept of identity. You need a concept of recourse if someone fails to pay their loan. You need a concept of credit scores. But when that happens, I mean, you're going to cut out so many people.
Okay, but that's a whole lot of what ifs. So are those problems actually being solved? I mean, are people actually coming up with identity and attestation and systems of trust that will pass financial muster?
Attestations, yes. I'm bullish on attestations because that's a trustful relationship. Identity, they've been trying to solve that since 2015, 2016 in the space. I'm not bullish. They're nowhere near where they need to be there. It's early, but it's certainly doable. There's no reason it's not doable. But the first is like attestation. Is there a way to do attestation on chain of someone's assets, for example? Yes, that's possible. We're getting closer to that right now.
How do you think you guys sit alongside various other folks out there working with the advisor community, really going after direct crypto exposure? I mean, it's a fairly thin difference between being in a pool protocol like this and just owning a bunch of ETH and then deciding what you want to do with it, or just walleting it yourself. How do you fit alongside that ecosystem? Because I know you're focused on cash, but people still think of crypto as its own asset class.
Yeah, you can do that with us too if you want to buy Bitcoin and ETH. But fundamentally, we're just adding liquidity to some of these over-collateralized borrowing and lending markets, institutional borrowers, and there's a place for them if there is a premium on them compared to like traditional fiat instruments. So we just want to be a platform that provides liquidity, and we are a middle person, but we make it very easy, and there's a lot of hoops to jump through without someone like us. So there's a place for both of that, buying Bitcoin and lending as well. So.
Well, we're running out of time here. How can people interact with this? How can they see it? How can they play with it? Is it a matter of just reaching out to you? Is there a demo they can see? What's the next step if somebody's curious here?
Yeah, certainly. So our website's meow.co. You can talk to our team right there, our sales team. You can talk to me directly, meow.co, and learn about it and see if it makes sense for you. See if you think the risk reward is there for any of these protocols, lending desks, or for the U.S. treasuries. You know how those work, obviously. So.
All right. Well, great. Well, I hope you guys have enjoyed this. I was skeptical about this, I'll be honest, at the front end of this, because in my mind, I'm like, well, just buying treasuries seems so easy. But the honest truth is, in doing research to come up here and talk, I talked to a whole bunch of financial advisors about how they manage treasuries, and almost universally the answer was, oh my God, it's a nightmare. I have to make this phone call, and then I actually had a couple of advisors tell me their all-in round-trip cost to manage a treasury ladder was about 25 to 40 basis points, which is insane, obviously, on the face of it. So it's been really great hearing about an option here. Thanks so much.
Thanks a lot.